How the rich avoid paying tax, from someone who is a multimillionaire with 30 plus years experience as a financial advisor, property investor, and a multiple business owner. Right, point number 1, borrow against your assets. So don't sell assets like property or shares when you need funds. Borrow against these assets instead, especially if the annual returns are higher than the interest you're paying. I'll give you an example. If you look at, say, property in the UK, it's not unreasonable to expect to make a return excluding rental income of maybe 7-8% a year. And currently the base rate is 4%. Simple maths really. And let's face it, the rental income pays your mortgage anyway. I always take the view that I'm not borrowing money, I'm not paying off a mortgage. Well, I'm borrowing money, let's be honest, but I'm not paying the mortgage. My tenants are paying the mortgage. And when there's a lot of demand for rental property, which there is at the moment, it's very much a landlord's market when it comes to demand. Now, the richest man in the world, Elon Musk, uses this technique of borrowing against his assets. What he does is he uses his shares, typically in Tesla, as collateral to fund other business projects of his. So he might start up another business. He'll use his Tesla shares so he can borrow the money to invest in those new businesses. Because if you take your money as income, you're going to pay a lot of tax on it. So this is what smart people do, wealthy people do. They keep using borrowing against their assets. I'll give you 1 or 2 more examples of this. So another strategy, as I mentioned just now, is to borrow money to buy properties because the rental income covers more than the mortgage repayments. And not only that, the interest reduces the tax on the rental income. So it's got to make sense. If you borrow money against assets such as property or shares instead of selling them, you pay no capital gains tax either. And in the UK, capital gains tax is at rates of up to 24% currently. When you die, your debts reduce the value of your estate, in other words, everything that you own, for inheritance tax purposes as well. And that's a further tax saving of 40%. So keep that debt until you die. Because the value of all fiat money, in other words, notes and coins, dilutes in value every year, that means that any borrowed money you have will reduce in value too. So this means the value of your debts reduces in real terms every year. Another clever technique is to lend money to your businesses interest-free and use the money in the businesses to buy appreciating assets. Now, these assets typically might be property, shares, other businesses, and even Bitcoin. And then what you do with the debt you've lent to the company, you repay yourself tax-free because it's just money you've lent. It's not an income you're taking. One thing I did, I wanted to buy 3 buy-to-let properties. So I just simply borrowed the money as a second charge mortgage on my main residence. And that gave me the deposits to pay to buy these 3 properties. It covered the stamp duty and it covered the legal fees. You can do this too once you build up a portfolio of properties. So point number 2 is for you to become a tax exile. Now, I know this isn't for everybody, but for the right people, it can work. So the idea is to emigrate to a country which has very low or zero tax rate. There are countries like Dubai, for example, where if you're a British expat, you can pay 0 taxes. And other countries like, say, the Channel Islands or Isle of Man, where you just pay 20% income tax and no capital taxes. In other words, no capital gains tax, no inheritance tax. So do consider that. Also, create businesses offshore if you've emigrated. They don't need to be in the same country. So you not only create businesses offshore, you also create bank accounts and trusts, because it can be a much more tax efficient way of managing your assets. And then move all your assets into these offshore tax jurisdictions. What you'll need to do is spend less than 90 days a year in the UK in order to remain non-UK tax resident. Otherwise, you'll be taxed on all sources of income in the UK and gains. You don't really want that, do you? After 10 years of having emigrated from the UK, you become non-domiciled, which means you then avoid inheritance tax as well. But it's quite a strict thing to do. You have to sever all ties with the UK. Point number 3, get a great tax advisor. This is one of those ideas that you call a no-brainer. Employ tax experts to save you far more in tax than they charge you in fees. Create businesses. Live off of your capital rather than your income. Use tax structures that minimise your taxes. And this includes choosing tax jurisdictions which have low or zero rates of tax. Use specialists for different types of taxes as well as for different tax jurisdictions. You may need more than one accountant in more than one country. And this is a key thing. Follow their advice. Don't follow the old saying of having a dog and barking. What's the point? If you choose your professionals well, particularly tax experts, you'll save far more in taxes rather than you'll ever pay in fees. Well worth it in my view. Point number 4, invest in low tax or tax-free investments. Let me just give you a brief list of some. I won't go into big detail about them. Pensions, ISAs, enterprise investment schemes known as EIS, seed EIS schemes, venture capital trusts. These all have varying types of tax reliefs. Typically, you'll get income tax savings of 30 to 50% when you invest in some of these schemes. They may be free of capital gains tax, free of inheritance tax. There's many benefits. But don't forget the old saying, don't let the tax tail wag the investment dog. In other words, don't invest in these investments purely for tax saving reasons. The investments have to stack up. Some of them are quite high risk, particularly EIS and CDIS, which involves investing in private equity. In other words, companies that aren't listed on the stock market. So they do suffer from a lack of what we call liquidity. In other words, not easy to buy and sell quickly to raise funds. There are one or two anomalies, interestingly, in the tax system. So, for example, UK government stocks, otherwise known as gilt-edged securities or gilts, are free of capital gains tax to individuals. Would you believe it? And there is a type of investment called an investment bond issued by insurance companies and subject to insurance tax, which is just income tax is the only tax you pay on investment bonds. Now, you can have a type of investment bond called an offshore one, which sounds exotic, but it only means investing typically in somewhere like a Channel Islands investment bond issued by an insurance company, or Isle of Man, or it might be Dublin. It may be further afield. It may be Cayman Islands, but the main ones would usually be the first three I just mentioned. The beauty of these types of investments is that if you're a British expatriate, in other words, you've moved abroad for a number of years, maybe permanently or maybe only temporarily, but you're going to be non-resident for a number of tax years. All the tax years you're non-resident in the UK, you benefit from a tax break called time apportionment relief. And what that means, what you've invested in for the number of years you're non-resident in the UK, it's free of all taxes. Can you believe it? And there's an unlimited amount you can pay into this type of scheme. Now, that doesn't mean it's not subject to tax in the country that you move to. So you'd need to double check the rules there, probably with a local accountant. You don't want to save tax in the UK to then have to pay tax when you're abroad. Doesn't make any sense. But there's quite a lot of tax breaks there on something called offshore investment bonds. They're just policies issued by insurance companies subject to income tax normally. So that's another good tax break for you. The fifth is invest in alternative assets. Now, when I mention this, it doesn't mean that all these assets are necessarily low tax or zero tax, but it does spread your risk more, and it can make sense to store these assets offshore as well. Some of them have got tax breaks. Let me explain some of the tax breaks. Certain gold coins, like the sovereign, this British coin called the sovereign, which on the face of the coin says £100, that means in theory that's legal tender. So it's a coin like other coins you own. It's not actually worth £100. It's probably worth £2,000. But those coins are technically, because they're treated as legal tender, they're not subject to capital gains tax. So it could be a clever way of investing in gold. Other assets you might wish to invest in include Bitcoin, collectibles, which I typically mean coins, stamps, signed memorabilia. You might then want to expand into other alternatives such as art, antiques, vintage cars, certain alcohol, wine and whiskey, There is an instrument called an NFT or non-fungible token. All you need to know what that means is it means you've got fractional ownership of an asset. Think of shares. They are fractionally owned, publicly listed shares, because lots of people can own a tiny share of that company. So it's the same principle, but applied to other assets, which could be digital or physical. So it could be like a physical work of art, for example, but you just might own a fractional share of it and still participate in the gains, but just for your fraction that you own. So that's alternative assets. For good tax planning, you really should consider trusts, because what trusts enable you to do is to retain control of assets without you any longer personally owning them. So it's almost as good as owning them. You can't take an income from it. You can't enjoy the benefit from it once you've gifted it away, but you can still have control, which may make up for not owning them anymore, which means that once they're outside your estate and have been outside your estate for enough years, then they're free of inheritance tax. So that's quite a benefit. But if you still want to take something out of the trust, you could always grant yourself loans from the trust. Say grant yourself, if you're a trustee, for example, or there's a group of trustees, they can lend you money from the trust. That saves you having to pay tax on it. That's quite a clever way of doing it. So consider creating multiple trusts, including offshore ones, which have more tax benefits than onshore ones. This is particularly relevant if you do decide to emigrate to a country which has got low or no taxes. But just one warning here, there are some countries that don't recognise the concept of trusts. So you need to do your homework there and speak to an offshore tax specialist in that tax jurisdiction, or do your own research. Maybe even ChatGPT will give you all the answers. I don't know. So there's just 6 ideas. There are many more. I'm just trying to give an overview. I hope you found it useful. Even though this is mainly designed for wealthy people, you don't have to be wealthy to get on the right track. And some of these ideas can apply to people who aren't yet wealthy but aspire to be wealthy. It's just a very good way of managing your affairs, because when you think about it, tax is one of your biggest expenses in your life. I mean, even someone on an average salary will lose 1/3 of their income to taxes. And if you add on the spending taxes, the average person in the UK, I would estimate, is paying about 50% a year on the average wage in taxes, indirect and direct taxes. So do treat this seriously. Obviously more benefit if you're already wealthy, but this does apply to far more people than you'd ever realise, and it's a very good way of keeping your costs down. It's all very well saving money on different purchases and different bills, but why not get your biggest bill down, which is your tax bill? So I hope you found that useful, and I look forward to presenting to you in future videos. Thanks for your attendance. Have a great day.